Hey, what's up? Edward here. So in this video today, I want to go through an investment strategy called growth investing. I will be explaining the philosophy behind it, how it works, and also show you what a growth portfolio looks like. This strategy is more towards the active investors out there that likes to handpick stocks for their own portfolio. And yeah, let's just dive right into it and see why so many investors love this strategy. So as usual, I'll go through the first part of my video and I'll just talk about a general overview of growth investing. So growth investing is simply like this. Growth investors are trying to invest into companies that haven't matured yet. These businesses are generally new, or the industry that they're working in is rapidly growing. If you're not familiar with the business life cycle, it looks like this. Growth investors are aiming right here. Companies in this category are trying to capture market share and beating out other competitors. They're looking for opportunities to grow their top line year over year because that's what growth investors look for. Sometimes these companies might not even be profitable. It's like trying to invest into Disney or McDonald's back in like the 1980s before they became a leader in their industry. Now flipping onto the opposite side, some examples of a mature company would be like Coca-Cola and P&G. These companies are very stable. They're just reporting stagnant revenues year over year. But the important part is that these companies have really strong moat and it's very hard to disrupt these companies. For those that don't know what a moat is, it's pretty much just a competitive advantage that the company has over others. Growth investors will usually try to avoid these types of companies because they're not either innovating or growing their top line. Now I want to talk about what growth investors look for in a stock. These investors love looking at companies with an amazing run rate because the more sales that these companies generate, the stock price will reflect that achievement. They will usually try to aim for companies with a revenue growth of about 15 to 20% year over year or higher. Another aspect that growth investors look for is how the company will pivot and reduce cost in their operations in order to bring in better margins. A really great example would be Tesla. They recently reduced the cost of their batteries by creating their own battery cell technology. FYI, the batteries are actually the most expensive part of their vehicles. These days, growth investors are looking for companies that are able to innovate. These companies are trying to disrupt industries that haven't really changed in the last centuries. Here are some examples. Lemonade, a company disrupting the insurance business, Beyond Meat, who's disrupting the food industry, and Tesla disrupting the automotive industry. Now the next step is optional, but when I personally use this strategy, I look for companies with a founder and CEO. Not just the CEO, but a founder and CEO. The reason behind this is because the founder usually has the vision and knows exactly where to steer the company towards success. The captain of the ship is very important when you invest into a company, so keep that in mind. Now I want to talk about the characteristics of a growth stock. So growth stocks usually don't pay a dividend because they actually reinvest that money back into the business. But the thing is, growth investors love it when there's no dividends. Let me explain for a bit. When there are no dividends, that's a great sign for growth investors, letting them know that the management team understands how to use that capital. Chamath Palihapitiya, who is a venture capitalist that I really look up to, said that the CEO must be a really great allocator of capital. If a stock issues a dividend, then that means that company doesn't understand how to use the excess cash that they're generating, which is why many matured companies actually issue a dividend to reward their shareholders for investing into the company. This isn't necessarily a bad thing, however, growth investors just doesn't like that these companies don't know what to do with the excess cash. Moving on, growth stocks usually have really strong revenue growth year over year. Profitability isn't the first thing that they look at, but usually they'll try to estimate when the company will actually become profitable. Also, majority of the time, growth stocks should have way more cash than debt on their balance sheet. Their valuation metrics will be high because a lot of investors already priced in future growth. Remember, there are only two ways to actually gain capital from a stock. First is stock appreciation and second are dividends. Now I want to talk about what a growth portfolio would look like. Before I get into this part of the video, I just want to say that I am not a financial advisor and this isn't financial advice. This is all for entertainment purposes only. So please don't just go out there and buy all these stocks that I'm about to mention. So here is a portfolio for growth investors. These allocations are all based on concentrating the portfolio in a couple holdings with a medium to high risk tolerance. The core positions would be Amazon and Facebook. As core positions, they would take up a big percentage of the portfolio. In this example, they take up at least 40% of the portfolio. Not only that, they have a really great risk to reward ratio against other stocks that I'm about to show you. As you can see, these two stocks do not pay a dividend. They bring in beautiful cash flows and they're investing those back into the business. Now the next couple stocks takes about 10% of the portfolio. Those positions would be Zillow, Spotify, Square, and Tesla. These aren't core positions because their cash flows and profitability profitability aren't that strong. But if we look into the revenue, they're all growing in a linear pattern, which is what we want as a growth investor. The remaining 20% are held in cash in case of any buying opportunities that the market presents itself. Now I want to talk about the advantages and disadvantages of growth investing. So one advantage of this strategy is that you'll be able to find a 10-bagger, which is a word that was made famous by the legendary investor Peter Lynch. A 10-bagger is a stock that makes you 10 times your investment. This means a 10-bagger stock will give you a 1000% return on investment. We can see this happen with many growth stocks today. For example, Apple was a 10-bagger, Microsoft was a 10-bagger, Tesla was also a 10-bagger, and lastly, Amazon was also a 10-bagger. And you should get the idea by now. It's a great way to build wealth, especially if you do your due diligence and research. Now on to the disadvantages. Lately, the newer investors have adopted the growth strategy because, to be honest, who wouldn't want to 10x their money? Everyone would love to make their $10,000 investment turn into $100K. However, it's not as easy as people think it is. It requires a lot of time, effort, and research in order for that to happen. One miscalculation and your gains could go down to zero. Another disadvantage is that growth stocks are really volatile. If growth stocks don't hit the revenue targets, you should expect the stock to free fall very soon. So if you're that person that can't handle seeing your investments go down by 10, 20, 30, 40, 50%, then this strategy isn't for you. I would bet that a really big drop in the stock price will make you panic sell immediately. Now I want to talk about who should be using this type of strategy. This is best suited for investors that want to get into a company early that has the potential to dominate the world. It's great for those that can also take risk because this strategy is very risky. It's better for the younger investors that have really little capital because the stock appreciation can be used at their advantage, because getting rich off dividends requires an immense amount of capital. Personally, I think that if you have really small capital to play with, then this is the best strategy. And then later down the road, when you hit the 7 or 8 figure mark, then the dividend and value strategy could be better. Now I want to end my thoughts on growth investing. This is probably one of my favorite investment strategies out there because it's best suited for me. As I'm young with really small capital, I'm able to take more risk with my positions. The greatest investors out there use this strategy before, and that's generally how they all started. Examples would be Warren Buffett, Bill Ackman, Cathie Wood, Peter Lynch, and many others. At the end of the day, this video was here to help you understand what growth investing is all about, and now it's up to you as the investor to decide if this strategy really works for you. That wraps up for this video. Let me know what you guys think. Are you going to be using this strategy or you're going to use something else? Let me know in the comment section down below. If you got a lot of value out of this, remember to hit that like button down below. Feel free to subscribe if you're interested in my content. Thank you for watching, and I'll see you all next time.